I want to put up a chart here to talk about this question of ECB raising, and what it does is compare financial conditions in the United States and Europe. The white line at the top being the United States and the blue line being Europe. And actually, is this something of a constraint on the ECB? Because they don't have quite an easy a time of it as the Fed does.
That's true. And I think, honestly, they're behind by a couple of years. If you think about what happened during the sovereign debt crisis, the ECB actually raised rates coming into that crisis, and that really set off a chain of events that has kept the European economy a couple of years behind the U.S. And so even though we're talking about tightening right now, the reality is that, number one, you have no concerted fiscal policy in Europe, and number two, you are behind a little bit from an economic standpoint. And so there are still countries in the periphery that are not as strong. They're not as strong as Germany. They're not as strong as those core nations. And so you have a little less latitude to be able to take steps to tighten policy right now at this juncture.
At the same time, what correlation is there between tightening rates on the one hand and financial conditions on the other? Because we've had the Fed tightening and not having often a particularly direct effect.
Well, I think the tightening that we're talking about here is particularly important. If you think about kind of the market for treasuries, we have sort of a global market for U.S. treasuries. So the Fed not buying bonds in our market doesn't have as significant an impact. There really wasn't as big a market for European sovereigns as there were that was created by the ECB's bond buying. And so I think that there are concerns that that market, the demand for that market, could fall off sharply if the ECB is no longer a buyer of last resort.